Most people who lose money in the stock market never see it coming. Not because the market surprised them, not because of a crash they couldn't have predicted, but because of something far more ordinary, something that was happening quietly in the background every single time they checked their portfolio, every time they made a decision, every time they felt certain they knew what the market was about to do next. The stock market, over long periods, is one of the most reliable wealth-building tools ever created. The S&P 500 has returned an average of roughly 10% annually over the past century. Diversified global equity investing has consistently outpaced inflation, savings accounts, bonds, and nearly every alternative available to ordinary investors. The math of long-term investing is not complicated. It is not secret. It is extremely well documented. And yet the average investor dramatically underperforms the market. Not by a little, by a lot. A landmark study by research firm Dalbar tracked investor returns versus market returns over a 30-year period and found that while the S&P 500 returned approximately 10% annually, the average equity investor earned less than 4%. Same market, same time period, dramatically different outcome. The market was not the problem. The investor was. So what is actually happening? The first thing is that people buy high and sell low. Not because they are irrational, because they are human. When markets are rising, everything feels safe. The news is positive. Your friends are making money. The cocktail party conversations are about how well their portfolio is doing. This is exactly when most ordinary investors finally feel confident enough to put money in. At the peak, right before the correction. Then the market drops. The news turns negative. The same friends who were boasting are now quiet or panicking. Your portfolio is down 20%. Everything feels dangerous. This is exactly when most ordinary investors pull their money out. At the bottom, right before the recovery. Buy high, sell low, repeat for 30 years. Arrive at retirement with dramatically less than the market would have given you if you had simply done nothing. Psychologist Daniel Kahneman documented the mechanism behind this pattern. He showed that losses feel approximately twice as painful as equivalent gains feel good. A 5% drop in your portfolio triggers twice as much emotional distress as a 5% gain triggers satisfaction. This asymmetry means that when markets fall, the emotional pressure to act, to do something, to protect what remains, is overwhelming, and acting is almost always the wrong move. The second thing is fees, and fees are where the math becomes genuinely brutal over time. The difference between a 1% annual management fee and a 0.1% annual management fee sounds trivial. Over 40 years on a $100,000 investment, it is not trivial at all. At a 7% annual return with a 1% fee, your net return is 6%. After 40 years, your $100,000 becomes approximately $1 million. At the same 7% return with a 0.1% fee, your net return is 6.9%. After 40 years, your $100,000 becomes approximately $1,400,000. The fee difference of 0.9% cost you $400,000. Not because the market performed differently, because a percentage of your returns was quietly extracted every single year, and that extraction compounded against you the same way returns compound for you. Most actively managed mutual funds charge fees between 1 and 2% annually. Most of them also underperform their benchmark index over any 10-year period. You are paying more to get less. The data on this is not contested. A 2020 report by S&P Dow Jones. Indices found that over a 15-year period, approximately 90% of actively managed large cap funds underperformed the S&P 500 index. 90%. After fees. The third thing is the illusion of control. Checking your portfolio every day feels responsible. It feels like staying informed. It feels like managing your investment. What it actually does is expose you to short-term noise that has no relevance to your long-term outcome, while dramatically increasing the likelihood that you will make an emotional decision at exactly the wrong moment. Vanguard conducted research comparing investors who checked their portfolios frequently versus those who checked infrequently. The investors who checked less often consistently made fewer trades. Fewer trades meant fewer fees, fewer tax events, and fewer emotional decisions made in response to short-term volatility. The result was higher long-term returns. Not from better stock picks. From checking less, Nobel Prize-winning economist Eugene Fama spent decades studying market efficiency and demonstrated that in a market where millions of sophisticated participants are constantly trading on all available information, it is extraordinarily difficult for any individual to consistently identify mispriced securities and profit from that knowledge. The market already knows what you know, usually better than you do. The belief that individual investors can consistently beat the market through research and timing is not supported by the evidence. It is supported by the stories we tell about the times it worked, and our selective amnesia about the times it did not. The fourth thing is taxes. Every time you sell a stock at a profit outside of a tax-sheltered account, you trigger a taxable event. If you are trading frequently, you are generating taxable gains frequently. Those gains are taxed at your marginal rate if they are short-term. Even long-term capital gains have a tax cost. Every dollar paid in tax is a dollar that is no longer compounding. And a dollar not compounding for 40 years, as we have established, is a dramatically larger number than a dollar. Inside a TFSA in Canada, gains compound completely tax-free. There is no capital gains tax on withdrawal. There is no tax on dividends. Every dollar of return stays in the account and continues compounding. The difference between a fully utilized TFSA and a non-sheltered account for an investor holding for 40 years can represent hundreds of thousands of dollars in additional wealth, not from better investments, from tax architecture. The fifth thing is the one nobody talks about at all. It is overconfidence, and it affects nearly everyone, including people who know they are susceptible to it. Research by behavioral finance researchers Brad Barber and Terence O'Dean analyzed the trading records of 66,000 households over a 6-year period. Their findings were striking. The more frequently households traded, the worse their returns. The households that traded the most earned net returns 7 percentage points lower than the market. Men traded 35% more than women and earned returns 1.4 percentage points lower as a result. The correlation between trading activity and underperformance was consistent, significant, and directly linked to overconfidence in one's ability to predict short-term price movements. The investors who did the best were not the ones who were most engaged. They were the ones who were most patient. The ones who understood that the market's long-term upward trajectory did not require their help. The ones who set up a diversified, low-cost portfolio and then got out of the way. So here is the actual picture of how most people lose money in the stock market. They invest when they feel confident and pull out when they feel afraid. They pay high fees for active management that consistently underperforms passive alternatives. They check their portfolio constantly and make emotional decisions in response to short-term noise. They generate unnecessary tax events through frequent trading outside of sheltered accounts. And they believe, with high confidence, that they are better at predicting markets than the evidence suggests they are. None of this requires a market crash. None of it requires a bad economy or a failed company or a global pandemic. It happens in good markets and bad ones. It happens to educated people and to novices. It happens slowly, quietly, and in ways that never trigger a clear moment of loss that the investor can point to and learn from. The antidote is not smarter stock picking. It is a low-cost, diversified index fund inside a tax-sheltered account, held for as long as possible, with as little interference as possible. Not exciting. Not a story worth telling at a dinner party. But the most consistent path to the outcome most investors claim they want. The market was never the problem. The investor checking the market every morning, making decisions based on yesterday's news, paying 1.5% in annual fees for the privilege, was the problem. And the fix was available the whole time.